Across Geneva, Houston, and Singapore, a pattern is forming. And that pattern looks like small commodity trading firms emerging overnight and operating like they have sovereign backing. And they do. Their capital comes from stablecoin treasuries, and they're quietly hiring top talent from trading operations, risk, and trade finance teams across our industry. If you're watching closely, you can see the shift happening in real time. Just ask the headhunters. They're the ones doing the hiring. So yes, there is a private stablecoin issuer which now finances more commodities than some regional banks. And this is only the beginning. So let that sink in for a minute. For years, stablecoins were dismissed as internet dollars, tools for traders, liquidity for DeFi, a convenience for crypto gamblers. But while the world argued about audits, pegs, and regulation, something far bigger happened behind the scenes. Stablecoin liquidity seeped into the real economy, into barrels, into mines, into agriculture flows, into the bloodstream of global trade. And nobody in Geneva, Houston, Singapore, or even Wall Street imagined the digital dollar would turn into a commodity financier. Yet here we are. Tether alone has deployed over 1.5 billion into commodity-linked lending. And I'm talking oil, ags, metals, you name it. They've even financed a crude shipment, quietly, surgically, without waiting for a bank. And the word on the street is, they're setting up small trading firms. 2 years ago, if you told traders that stablecoins would be becoming liquidity providers for physical cargoes, they would have laughed you out of the room. Tether, finance oil, please. But reality doesn't wait for permission. Tether now holds more US treasuries than Australia or the UAE, and they're bored of clipping 5% yields. Margins are shrinking, regulators are circulating, and narratives are drying up. So they did what every smart balance sheet does. They went hunting for real yield, and real yields live in commodities. A barrel doesn't need a fork. A grain of shipment doesn't need an upgrade. And copper doesn't need a white paper. It just moves. It generates cash. It carries the risk the world actually understands. Stablecoins are now used to mirror fiat. Now they're touching the stuff that fiat was built to finance, and the banks are just watching. But why? The moment Tether financed its first crude cargo, everything snapped into focus. If you want to protect a peg, you anchor it to the real economy. And if you can't own that asset, you finance the flows. The strategy was unmistakable. Move beyond the comfort of treasuries. Tie liquidity to production and finance the assets the world cannot live without. If you need more evidence, look closer. Tether bought equity in an energy company, financed oil traders, backed agri exporters, and signaled interest in infrastructure. And here's the genius. They don't need to own the barrels. They just need to fund them. Finance flows into cargoes. Cargoes convert into cash. Cash strengthens the reserves. Reserves strengthen the peg. In the meantime, the peg strengthens demand, and demand strengthens influence. This isn't crypto anymore. This is monetary geopolitics. Commodity trading is the world's original form of global finance. Every shipment and every loan, every movement is a credit line. Every deal depends on timing, trust, and settlement. But the system is choking. Bankers retreat. Emerging markets face dollar shortages. Swift delays kill deals. And documentation slows flows. And as for regulation, they're squeezing margins. But stablecoins solve all 3 points at once: time, trust, and transfer. They offer instant settlement, 24/7 liquidity, borderless rails, programmable collateral, escrow on-chain, and audit in real time. Picture this. I personally know a coal trader in Indonesia secures financing from USDT. Liquidity arrives in seconds. Tokens lock into a smart escrow. Funds release when the cargo is discharged in India. The financier earns yield backed by a real shipment, not a meme. No SWIFT, no delays, no intermediaries. Just code, cargo, and collateral. That's not DeFi. That's refi. Real finance. Of course, revolution never arrives quietly. They arrive with friction. Traders still trust names more than wallets. Jurisdictions overlap in ways no lawyer can untangle. And stablecoin issues still carry the baggage of the crypto past. But none of that stops what's happening next. Because the moment a single $1 billion commodity trade clears safely in stablecoins, the entire industry changes overnight. CFOs will start asking questions nobody has dared to ask. Why are we still waiting 2 days for settlement? Why are we still paying correspondent banks? Why are we still financing the old way? Once this happens, the dominoes fall fast. Emerging markets follow, producers follow, mid-tier traders follow, and the banks only wake up when the liquidity has already moved. And when they look for it, they'll realize the truth. The capital isn't coming from them anymore. It's coming from blockchain treasuries with balance sheets bigger than entire nations. So let's keep an eye on metal trading businesses, the oil trading firms and their assets, or the new energy companies cropping up all over the shop. I even hear farming giants of coffee are flying the flag in the agri space. This is where belief is shifting from paper promises to physical production. Stablecoins won't replace dollar. They'll become the dollar's fastest, harder, and more honest twin, the one financing the real economy, while banks sleep. The future won't be coded. It will be dug, drilled, shipped, and settled on-chain. Stablecoins aren't invading commodities. They're financing them, quietly, and soon, inevitably.